Well, I am very pleased to invite AJ back to the show. It's been a while. AJ, you're still apparently hiding out from the authorities. Is that right?
Exactly right. Hi, Randy.
So, for those of you who don't know, AJ prefers uh, to not show his face. I've asked some of his friends, and they all think that it's true that that's a better idea. Is that also?
Exactly, exactly. I don't want to cause anyone discomfort.
All right. Well, what we're going to do today is we're going to do what AJ does best. For those of you who don't follow him on X, you are missing out for sure. You should even be subscribing to him. I only subscribe to two people, and one of those people is AJ. Um,
Oh, sorry to interrupt you, but I didn't know that. Much appreciated.
yeah, I think I was probably one of the first to follow subscribe to you. Um, what AJ does, of course, is he does massive reports, financial reports, detailed technical reports about not just Tesla but about other companies as well, and more specifically, a lot of the competitors to Tesla, uh, giving us some indication of what their financial strength looks like, so we know whether the competition is really coming or not.
Yep, that's a good summary.
Yeah, so I was curious, AJ, this morning we're going to be looking, of course, at Tesla's fourth quarter numbers as you're anticipating them. Of course, we don't know the numbers yet, but this is your anticipation of them. But out of all of the companies that you have been watching, all the ones, the competitors to Tesla, who do you think has the best shot um, at actually still existing 10 years from now?
Um, the best shot amongst all the companies I'm seeing, um, I have to say BYD,
Okay.
because they have become now the number one Chinese automaker. And this is widely known. The Chinese government tends to have certain champions in each industry, and it appears like the new champion in the auto industry is BYD. They have been phenomenally successful in their home market. They have pushed out all the old legacy Chinese automakers, like SAIC, like um, I mean, Geely is also doing quite well, but some of the other large ones, they are struggling mightily. SAIC used to be the number one, but another old one that is shrinking is Great Wall Motors, and a bunch of others. So all the old Chinese automakers, they're basically shrinking or struggling mightily, and the new Chinese automakers like BYD, etc., they are gaining market share, and BYD has by far been the biggest market share winner. And so if they can just maintain their strengths for a few more years, that will carry them to the end of the decade. And their home market is so gigantic that even if Europe keeps the market closed with tariffs, and the US, they have enough space to grow. Plus, BYD already started launching production in Europe, building production capacity, basically the Japanese playbook in the 70s, a repeat of. And so basically, sooner or later, I mean, pretty soon, BYD will be selling meaningful volume in Europe out of European production. It's an
Oh yeah.
important note.
Mhm.
Yeah.
All right. So I have always felt in the 2 years that I've really been following the auto market in detail, I had sensed that Hyundai Kia was also had a potential to make it to that 10 years from now mark. But you've just recently really done a report on Hyundai, at least, where you felt they were struggling themselves.
Yeah, so if for exactly that reason, because Randy, you were not in minority. Actually, I ran a little survey, And most people, and what I read in the press, it seemed like even most journalists, etc., they all felt like Hyundai, and just big picture for people who don't know, Hyundai Kia is the same thing.
Yeah,
Both belong to the large Hyundai Corporation, which is a huge industrial conglomerate, and the auto piece is one of the biggest businesses. But there's a lot of other stuff like shipping, and I mean, it's a huge list. They're basically in all big industries a player, and so anyways, they both belong to this Hyundai group. So there's Hyundai, the brand or the car company, and then there's a separate listed entity, Kia, but it's all one family basically, and they have in general they are seen as a quite financially strong player, and the problem is, I mean, the reason why that is, they show actually pretty good profitability numbers. However, they also this also came down recently. And recently, I referred to the last few quarters, but when you dig a little deeper and you look at cash generation, and cash generation is ultimately what matters,
right.
not your profitability, that is extremely negative.
I see. Okay. All right. Well, let's go ahead and dig into Tesla then. So we've got
Yeah.
the earnings
mm,
earnings call coming up next Wednesday. You are last I checked, I'm hearing different street estimates. The street, I think, according to at least one article I read yesterday, was at 72 cents earnings per share. You've been at around 70
Um,
cents.
yeah,
Uh,
I can. So I just looked at the Bloomberg terminal, which is the second most looked at source on Wall Street, and the Bloomberg terminal has right now 74.5
oh,
cents.
okay. All
So
right.
that's literally as of just a few minutes ago. So and that's probably not going to move meaningfully at this point. Because we're just a few days out. All analysts will have reported their numbers already. The other source that is used, and sometimes there's small variations for some technical reasons. We can maybe discuss in another video, but the second main source is FactSet. These are the two primary sources people like, or houses like Goldman Sachs, Morgan Stanley, JP Morgan, the leading investment banks will look to, and also the leading investment firms.
Okay. All right. In FactSet, what is FactSet's number right now?
Actually, I don't know actually,
Oh, okay. All
because
right. All right.
I don't have FactSet because it's
Okay.
very expensive.
Okay. All right. Okay.
Yeah.
All right. So let's go ahead and I'll turn it over to you now.
Yeah, thank you very much. So I prepared this overview slide, and here you can see really the key metrics that are relevant to probably most investors. And the key numbers that obviously everybody will be looking for is the earnings per share number. And I'd just like to point out, there are different EPS numbers, but the one that matters for valuation and hence for investors most is the non-GAAP diluted number. So this is the correct EPS to use for any type of valuation analysis, which is usually based on a type of multiple, PE multiple, and this metric I arrive at 76 cents. So this is a 6.6 increase quarter on quarter, and just to give you a quick briefing on how this works. So I'm showing here my estimate, and then the last reported quarter 3Q, and then also the the comparable quarter of last year's, because in the auto industry there's seasonality, and that's why it's very common to compare uh, the the current quarter with the last year's the same quarter, so 4Q 2023. So the year on year here shows the change from 4Q 2023 to 2024, and the Q on Q, the change from 3Q 2024 to the 4Q 2024. So if we look at this change, so this is, nice increase, both around 7% EPS increase. Um, what what dragged down my first estimate for 4Q, because after the 3Q earnings report, I was quite enthusiastic or optimistic about 4Q. My EPS was significantly higher. And the primary drivers why it came down to this level now was, number one, the guidance that Elon put out was not delivered on, and we can discuss maybe later perhaps why that was the case. But the guidance implied 515,000 vehicles. So we came in below that by roughly 20,000 vehicles. And then the other thing that happened that had a huge impact is actually what you see here in the automotive gross profit line. You can see it came down even though the revenue increased. And the reason for that was that Tesla engaged globally in massive discounting campaigns, which also includes offering highly attractive leasing deals. This is also a kind of discounting, and the same for financing. There was widespread offers of 0% financing. Of course, interest rates are not at zero, and for that reason, Tesla is subsidizing these financing rates, and the cost of that, the financial cost, Tesla takes out of the revenue. Hence, if Tesla sells a vehicle, let's say for $40,000 and it's financed at 0%, Tesla actually doesn't recognize in the revenue line $40,000, but something less. And this all then basically lowers the average selling price. And this then puts pressure on the gross profit in the automotive segment. And for that reason, we will see a sequential decline. So sequential means quarter on quarter, a sequential decline in gross profit in automotive from just over 4 billion to just over 3.7 billion. But on the flip side, on the positive side, the energy and storage business came in very, very strong, energy deployments. And here in this segment, we see actually a quite substantial sequential increase, almost 33% increase from one quarter to next quarter is my expectation. And if you look at the year on year, it's up to over 200%. It's quite wild because this is also not, we're not talking, the thing is Tesla has already gotten quite large, and we just should maybe pause a second, look at these are large increase in gross profit just in this segment of going from 300 to 725. Of course, in the context of Tesla, because of the significant valuation, it looks small, but you should just appreciate that this is a significant business and it has grown quite substantially. If you IPO'd this energy business, if you could rip it out of Tesla, this alone would also be quite valuable because it grows so quickly and it's quite profitable.
Right.
And so and with that we go to the operating expenses. I expect a very modest increase, and we can dive into it later a little bit why that is. Tesla did in 2Q 2024 this all-time largest headcount reduction with and I quote the CFO, with over 1 billion annualized run rate savings. And this clearly brought down the cost, and you can see it in the year, sorry, in the year on year it came down. Of course, this is my estimate, but I expect this line not to increase significantly out of prudency. I assume a slight cost increase, largely because of the significant increase in volume that I expected, because in the operating expense line, which comprises two main components, one is R&D expenses, the other one is SG&A, so selling, general, and administrative expenses. Some of that expense is driven by volume, a smallish part, and for that reason, I would expect here some increase, but it's not a significant needle mover. And then overall, we get to the operating profit line, and you can see that this is virtually the same. But this is not, I'm plugging these numbers, and this is just the mathematics. Right. When you run all these drivers, we end up in virtually the same operating profits as a 0.1% decrease. But, and this is really interesting, this time, and I'm not breaking this out on this overview because normally it's not really that interesting, but this time it is. The between operating profit and profit before tax, there are the non-operating items. So non-operating items are any item that is not considered part of the core business. And in Tesla's case, this is the main driver of non-operating expenses, typically net interest income, because Tesla has very little debt. So the net interest income is basically interest income less interest expense, and because Tesla pays very little interest on debt, the interest income on its huge cash cushion is so substantial that it's sort of that the interest line is a positive. So that's a meaningful item in non-operating items for Tesla. But on top, there's the currency fluctuation.
Mm.
So that's the other big driver in the non-operating line, and we can dive into it later in detail. So this item is very important this time around. Um, and that item, so the reason why it's so significant is because Tesla has very large operations in China and also very large operations in Europe, and so the most European sales are denominated in euro. And most Chinese sales obviously denominated, or all Chinese sales are denominated in Chinese yuan. So Tesla has entities in these countries and they take the money in, and it's not like every quarter Tesla Texas collects all these funds from these entities. No, they sit in these countries, but Tesla has to consolidate these amounts, it has to sum it up, and for this summation, they have to translate it into US dollar. And depending on how the US dollar moves relative to its currencies, it can be a significant positive or negative effect. And because these balances are so large, this creates a multi-hundred dollar movement typically, and it can be a positive or negative, but we can dive into this a little later. And so this is then how we then get to the profit after tax line. I assume in terms of tax rate, just the tax rate from last quarter, it's virtually impossible to bottom up calculate a tax line on SEC filings. So you're best off just using the latest tax rate, which should be broadly in line with other S&P 500 companies that have also large international exposure, because tax accounting is its own kind of accounting world and is extremely jurisdiction by jurisdiction. So anyways, so the bottom line is I expect profit after tax increase because of the non-operating line, because again, the operating profit was the same.
Right.
So the change must be coming from a non-operating line. And I expect a 7.1% increase. And in terms of EPS, the increase is slightly less because Tesla has a bit of non-controlling interest. Non-controlling interest is an amount you have to deduct before you go to the EPS calculation. So you have to calculate a shareholder's net income, which in Tesla's case is slightly lower than the profit after tax for that reason. Plus, you have to account for changes in the number of shares outstanding, which always keep growing in Tesla's case, because Tesla pays their employees also partially in stock. So there's share-based compensation, just like in most American listed companies. And when you take these effects together, you have a slightly lower EPS increase sequentially. And then we get ultimately to the number that really matters, even though the market is hyper and traders are hyper focused on EPS. The number that really matters for a business at the end of the day is free cash flow. So free cash flow is you basically take your earnings from the P&L, so your profit after tax, and you add back all the non-cash charges like depreciation. Depreciation is something you paid long times ago, but you still need to account for it. So it's a cash out long time ago, but so you have a notional deduction. You add all these non-cash charges back, but you also deduct other charges that were not reflected, and this gets you to operating cash flow. And then you have to take out what you spent on investments, typically called capex or capital expenditures, and then you arrive at the free cash flow number. So the free cash flow is what the name already implies, is really, if you look at all the cash ingoings and all the cash outgoing, what's left after you paid for everything to keep the business alive and growing, that's what's left. And in theory, that this is a rough proxy of how much capital return the company generates for shareholders, and that's why it's a key valuation metric. And but because it takes effort to calculate it, often people just use as a shorthand PE multiple, which is not that great in the auto industry because it's highly capital intensive. And that's why you need to look at this. And if we just briefly touch on our Hyundai discussion, Hyundai looks quite good up to this line.
I
But
see.
then when you look at the free cash flow line, it looks awful. And that's why you always have to look at all these things and not these things in isolation. Otherwise, you get the completely wrong impression. And then if we do like a quick sort of margin review, so the gross margin,
Now for those who are just listening and they have a hard time seeing the chart, maybe they're in the car or whatever, what was the total free cash flow and comparing to,
ah,
yeah.
yeah, sorry, thanks. I never ended up mentioning it. So in the third quarter, Tesla reported just over 2.7 billion. And in the fourth quarter, I estimate it's going to be just over 2.8 billion. So there's a 3.4% increase quarter on quarter. And even though this increase might not be very impressive, 2.8 billion in free cash flow is very, very, very good in the automotive industry. And I mean, the reporting season is just about to kick off, so we don't know yet. But I expect Tesla will be top five globally amongst all automakers, including the very large ones like Toyota, Stellantis, VW, General Motors, Ford, etc. Tesla most likely will beat, to be honest, all of them with the exception of Toyota. But we'll have to see because in the auto industry, um, because it's so capital intensive, there are huge swings all the time in cash flow. So, but Tesla has had really quite consistent cash flow despite the massive AI spending that none of the other large automakers is engaged in.
Right.
So this is all very good. So with that on the margins, yeah, so gross margins are coming down because of factors we discussed before, large discounting, financing and leasing deals, energy storage. I expect margins to come down. They were at record 30.5% in the third quarter. So what I did is I looked at the energy storage market globally, and what I found was that significant Chinese players um, are in the process to mount some serious competition. And when I look at the prices they offer on the market, it's hard for me to imagine that Tesla can defend these high margins for very long, and that's why prudently I assume that some margin erosion is setting in. And the reason why I'm slightly uh, cautious about the margin here is because I see prices where some Chinese players offer a kilowatt prices installed below $100. And in Tesla's case, the number is slightly above $300.
Mm.
So there's a massive difference. Of course, it's not that straightforward. It's not just a function of price because it's also a function of how quickly these projects can be delivered. Tesla has the most experience because they've built the most projects globally. Also, there is some security concerns, especially in the US. I doubt that Chinese companies can sell a lot of these products in the US because these products are full with chips and they're wired they're connected to the internet. So there would be, national safety concerns or whatever you want to call it. So some companies in the US will probably for that reason not touch Chinese product. And there are other issues. So it's really, so the competition will affect Tesla more in geographically rather on a global scale would be my expectation. Just like in the auto industry, where basically the auto market in Europe and North America is right now shielded by tariffs, so the Chinese can't really get a significant foothold there. And then lastly, the other big segment Tesla has is service and other. So this has also seen some quite significant year-on-year margin improvement. This used to be very low margin, 2.7% last year in fourth quarter. Last year, I mean 2023, and in fourth quarter of 2024, I expect 8.9%. This is a slight sequential increase from the 8.8% Tesla delivered already in 3Q. And so the service and other is, as the name implies, basically all the servicing Tesla does on the significantly growing vehicle fleet, but it also includes paid supercharging sessions, which also include a lot of non-Teslas by now. It also includes the insurance business. It also includes all the in-house collision repair Tesla does, which is still a not fully utilized opportunity, because in a lot of country, all or almost all collision repair is done by partners. I just recently had a Tesla, one of my personal Tesla vehicles had a collision with an animal, large animal, and there was
Ouch.
quite substantial damage on the vehicle because it was a high speed impact.
Ah,
So basically, I talked to Tesla, and they basically told me that this type of work is done by certified partners. So
gotcha.
that revenue is mostly outside of Tesla, but and we have seen this in other markets. Tesla then brought this business in-house. So this is opportunity for Tesla. So anyway, so this is basically the high level overview. We can now dive into sort of the details. We can't cover it here on this call anyway because it's too much. So perhaps we talk about the item that I discussed previously, which is the non-operating item, which is also perhaps one of the most overlooked items. I just need to find it because there's so much stuff. As is operating expensive, operating margin, as interest income, which is one part. Here you have the detailed breakdown, but let me get to the interesting piece. Okay, here we go. So the way this works is, so let's look at this breakdown of the income statement. And we noted earlier that operating income is basically the same, but profit before tax here goes up quite meaningfully. And you can see here that the three components. One is interest income, interest expense, and then other expenses and income. And as we discussed, this line item is driven mostly by FX changes. So FX is exchange rates.
Right.
So and so and last quarter, and if we just look at the interest income expense, that there is I expect a small reduction in interest income. Can explain why later, but it's not a huge needle mover. I expect a small increase in interest expense, so net no change in interest income expenses basically. So the change between operating profit and profit before tax is entirely driven by the absence of negative exchange rate effects, because last quarter Tesla reported a negative impact of 270 million.
Wow.
And this is quite a lot. I mean, given you're looking at a roughly 2 billion earnings line, you're losing 270 million just on FX. And the reason why I think it's going to go down to a quite minimal amount, I'm estimating 19 million negative, is because I built an FX model. So basically, Tesla discloses a global FX exposure by currency. And what I did is based on reported sales in each currency, like the Norwegian krona, the British pound, Chinese yuan, the Eurozone, I can estimate the revenue in each of these geographies or countries, and then I just need to look at the change in average exchange rate in a quarter, and then I can calculate the currency effect. The currency loss or gain for each exposure, and then I can just add it up, and then I can estimate the net currency impact. And so this is really simple, it's just a lot of work. It's why few people do it. And but if you do it and you back test it, my model was extremely accurate. And in the last couple of quarters, ever since I built it, I precisely forecasted
Hmm.
the what Tesla would disclose. For example, until uh, 2 quarters ago, Tesla disclosed always on the, I think, the second or third page of the shareholder deck. They always uh, they always have these main bullets, what drove the financial performance, and they always noted, oh, FX impact zero point 0.1 billion or something like that. And when I use my FX model and I try to estimate these nodes Tesla would provide, it was always spot on. So I used that same model to then calculate this P&L line. So I have a very high degree of confidence that that the FX impact will be negligible compared to the last quarter, and that is a significant driver. And the only exception would be if there would be another other item, a non-FX item that had an impact, but this is something you cannot forecast.
Right.
And given Tesla's scale, there shouldn't be any other line item that is, meaningful, that is like more than 50 million or so. So this is low probability um,
Okay.
miss here. So this is interesting because this is so much work for something that's usually not that interesting. This could be where you could have an edge over Wall Street analysts. I've looked at many Wall Street analysts models in my time in investment banking because I had full access, and you'd be surprised how simplistic many of these models are.
No, no, I wouldn't
Um,
be surprised. Now, it's just, not at all. So,
I, I don't want to trash them or anything, but it's just that, and the thing is, oftentimes a simple model doesn't mean worse model,
right.
but when it comes to these technicalities, sort of going the extra mile often pays, especially when you have this, when we have certain currency movements. Um, yeah, I think I'm looking at the time. I think we are still good. I pause for a moment to give you a
Yeah.
chance to react, Rainy.
Yeah. So let me ask you the questions that I think are also probably not being contemplated by those less sophisticated analysts. And I'm not 100% sure what you're doing with these things. So I'm just curious on these. So one would be the IRA battery credits. How are you taking into consideration the $35 per kilowatt hour for domestically made, so it'd be the 4680s at least. Maybe there might be some other batteries being made at this time. We don't really know about that CATL line yet. But how do you take into consideration the $35, and then we also have the $10 for the pack, which Panasonic or other batteries made in the US and maybe batteries made in South Korea that we might be importing would qualify for the $10 per kilowatt hours on the pack assortments. How are you taking all that into consideration?
Okay, so first of all, the key point here is that this goes beyond fourth quarter of 2024. This is a 2025 topic. So this has absolutely zero impact on what's going to be reported in just a couple of days next week. So this is one key distinction we need to make. So any of the numbers we just discussed in this next quarter out, sorry, the next unreported quarter outlook, which is technically the last calendar quarter, has absolutely no impact. So Tesla already booked all these credit revenues, all these credit sales, yada yada yada. So everything you just asked about affects 2025.
Ah,
So so basically, what I will do once we have certainty, I have also provided a 2025 outlook, but this is not yet updated. I've been asked a lot about this. I want to first of all listen to the 4Q earnings call, what management has to say about these topics, because this will be most important. I expect they will comment in some way on these things, because this is probably right now the biggest topic amongst professional investors. And the so and again, we have to keep in mind this is only a couple of days away.
Right.
So for me now, trying to make a big fuss and then management says something fundamental makes no sense. That's why I'm just too lazy to do spend like 2 minutes. Yeah. So anyways, so we need to wait a few days, and then I will do a full update and the way I would reflect these things. And let's just assume, I'm just making something up. Let's say Tesla tells us, or from other sources in a couple of days or weeks, we learn that Trump administration decided or has implemented the end of these credits by, let's say, end of 2Q.
Right.
Then I would basically reflect them in my modeling, my cost modeling, up until 2Q, but then after 3Q, I would account for these credits, which are in the way it works is they are basically offsetting production cost.
Right.
Tesla has production cost of, let's say, $100, and then they get like, let's say, $30, $35 credit, whatever, and they only recognize 65. So this would affect my COGS projection for the vehicles. But here's the thing: this is not global vehicle production.
Right.
This is only, obviously, this would only affect US production, and then there's a lot of nitty-gritty stuff. You have to think about, does it apply to the full US production? Does it apply to all the models? So there are all sort of what I would call dilutive factors to this negative impact. That's why it's quick to overstate these effects. On top of that, you always have to have some sensitivity around management's actions. Management has Tesla is not stupid. The core task of management is to anticipate things like that and plan for them. And I guarantee you, since 6th November, since it was clear Trump won, Tesla started preparing for removal of these credits and devise plans. Imagine that you're a VP at Tesla, and Elon asks you, okay, how do we deal with cost once the credit is gone? You can't sit there and just ramble around. You need to have a clear plan, otherwise your career is limited.
Yes.
And so this is like very common in corporates, and I used to work with corporates quite closely. There are people, all their job is just plan for this stuff, because having a good plan in the drawer, if something like this happens or everything is set up, it pays huge dividends.
Sure.
And so I expect some mitigating management measures will be in place by the time this has gone through the US legal machine, because my understanding of this topic is it's not something, it's not like a switch a Trump can just turn off.
Right.
It has to go through a certain process, and then it has to be implemented, and as everything, it will take some time, so it's not instantly gone. But again, there's a huge amount of uncertainty. But then also, once you think about these losses of credits and how this affects not only Tesla but also the competition, you have to think more broadly. How does this affect the marketplace? The marketplace,
Sure.
specifically in North America, and I can imagine that people like General Motors. I think what they're going to do is they will dial back their EV ambitions. They will because the cash burn on each EV sale will just be too high.
Right.
They just now, including all these credits, expected like a break-even point. If you just read their commentary from the latest earnings call, without the credit, and they made a big deal about this on the investor day, that they pointed at various points to the credit and how massive it is, etc. That there are other automakers also in Europe that sell vehicles in the US that talked about this, and one automaker just recently made this a big point of their equity story. This might have been a bit premature, but anyways, long story short, this is a big cost reduction drive, and it's gone potentially in a few quarters. So what's going to happen is all these EV cash burners, they will likely dial back the EV business, especially given that Trump wants to remove sort of what he calls the EV mandate, which is not exactly defined term technically, and give people basically the choice as he says. And I think people like General Motors and Ford, they will basically significantly de-emphasize EVs, but there is a large EV customer clientele in the US, and I think a lot of people who used to be or looked into potentially buying an Equinox, they might end up buying a Model Y. So there are all these secondary effects. So I don't think this tax credit, etc., removal is as clear cut as some doom and gloom Tesla forecasters make it out to be.
All right. Well, let me just real quick. I'm still not quite understanding why this doesn't impact fourth quarter's cost of goods. Is because the $35 and the $10 was in effect in 2024, right? Why isn't it affecting 2024 cost of goods?
So the forecast here is for 4Q 2024.
Yes.
And my understanding is there has not been any change to the tax credit during that quarter.
No change, but what I'm saying is how do you apply the amount of credits to your cost of goods formula right now in fourth quarter?
Oh, right now. Okay, so basically, okay, sorry. So I basically so basically, very simplistically, I always look at the implied, because we don't know the exact amounts. It's
Right.
not disclosed. Tesla doesn't give us the exact COGS breakdown.
Yes. Uh-oh. We've lost you. Can you hear me? AJ, we've lost you. I can't hear you. It says you're talking, but I can't hear you. Can you?
When the recording stop?
Okay. Okay, we're back. Okay.
Okay. Okay. I think that the feed just broke off for a second. So basically, um, so so let me start over again real quick.
Yes.
So in third quarter, we saw this unprecedented, almost unprecedented cost reduction sequentially. So what
Right.
happened? Tesla clearly was able to recognize these government incentive, let's call it, and so this created a new lower cost base. In the fourth quarter, I do not expect any incremental change beyond the effect of the volume increase. For that reason, I forecast a slight sequential increase, but not nearly as large as the 3Q one we saw. And I have this actually in the deck. In the average production cost. Yeah. Okay. So yeah, this on this slide, I even put the exclamation mark, because this was in the third quarter, this was the primary surprise.
Yeah.
Because nobody had on the radar that Tesla could, again, sequentially, not year on year, from one quarter to the next quarter, could lower average production cost by, by almost $1,900. This is huge, because Tesla has been optimizing its production, etc., for a long time, and this is also not due to lithium prices, because lithium prices have been relatively low for a while. Of course, there are delays on in terms of when these lower lithium prices actually come through in the P&L, of course, but lithium prices did not explain this. Also, other raw material prices like steel is important, copper is important, and a bunch of other things did also not drive this. So clearly there was something else, and the only thing that can really explain this is the US IRA, and so that was really interesting to watch. And if you look at my forecast from that lower cost base, I only expect another sequential reduction of $325.
Mhm.
So this will get us down to average production cost for the 3 and Y product line of, by my estimate, globally, I'd like to point out, of $32,000, which obviously also includes the Chinese production, which will be lower because simply the Chinese, the entire supply chain is just much lower cost. And I mean, this is widely known, automotive industry, and that I don't know exactly, but if I had to guess, the Model 3Y in China, they're probably already sub $29,000, I guess.
Okay, and then in the same vein, I refer to this as the Jeff Lutz theory. Jeff b believes, and you, I think you are showing it here on the chart that we're looking at, is that Tesla roughly finds ways to get about 2% per quarter out of the cost, the overall COGS, just by better efficiencies, the ramps, et cetera. So are you aligned with Jeff on that rough 2% per quarter?
I mean, I have here the quarter-on-quarter change here, so we can look at the numbers. So the underlined percent here is the year-on-year, and the non-underlined is the quarter-on-quarter.
Okay.
And the 2% you mentioned, so nails it here,
Okay.
nails it in the second quarter of 2023. Here it's a little less in the third quarter of 2023, but here was the Model 3 changeover. Keep that in mind. So
Mhm.
that obviously had slowed down cost reductions.
Right.
Then in the fourth quarter, there was an acceleration. Um, then in the third quarter, sorry, in the first quarter of 2024, there was another slowdown, but that was a clear volume effect because the 1Q 2024, if you remember, was this
Huh.
huge delivery miss,
Right.
which was driven by a bunch of one-off effects and logistical issues. And so I would ignore this data point. Then we go back to 2Q, back to 2%. So then 3Q had this massive drop because
Right.
of the IRA. Um, so bottom line, so Jeff's comment makes sense to me, but based on that, I might be a little conservative. And the reason why I might be a bit conservative is just because this massive drop in 3Q. So I want to be careful to be not. But the thing is, as a sort of an analyst, it, usually you usually you want to be slightly more conservative
Uh-huh.
rather than the opposite, because in financial markets, for in terms of as an investor, you're you're rarely rewarded for being too optimistic.
Yeah.
But you're usually not losing out too much on being slightly too conservative. This is sort of the background why I try to. And the other thing is, but this doesn't affect my analysis anyway. If you always overestimate EPS, people also start not taking you serious anymore. But
All
this
right.
is not something I include in my analysis.
All right. And the other now I haven't done any deep dives. No spreadsheets for several quarters now, but we have the Cybertruck becoming more and more significant as it ramps up. And I was wondering how you took into consideration potential cost savings on the Cybertruck, and as they ramped, while at the same time, Cybertruck selling price has been coming down.
Yeah, so what I do is I model Cybertruck um, based on trims. So I make assumptions on the distribution of the trims at the different selling prices effectively, and um, and then have basically a blended price. And so this the one element. So this would give you then the revenue line for the Cybertruck, which is also included in this report. And then I estimate the production cost. And the way I do it is I obviously try to look out for what the company tells us. But the company doesn't disclose Cybertruck separately,
Right.
so we can only the CFO provides some very helpful commentary. He did so during 2Q 2024 and also during 3Q 2024. And with his commentary, you can back out roughly where the production cost of Cybertruck comes out. And in my report, I actually put here one of his comments. So in 3Q, CFO said, Cybertruck production increased sequentially and achieved a positive gross margin for the first time. So this is a very valuable information. Of course,
Sure.
positive gross margin for the first time. Does this mean 0.1%
Yeah.
gross margin? Does it mean 5% gross margin?
Yeah.
We have no clue.
Yeah.
But prudently in my modeling, I assumed a almost 3% positive gross margin. And then by calculating the basically the volume weighted average price of the Cybertruck, I can back out the production cost. This is what I've done. And of course my volume weighted Cybertruck price can be wrong if I get the composition of the trims wrong. For example, if people bought a lot more expensive versions than I expected, of course there's some uncertainty, but I don't pull these numbers out of thin airs. There are ways how you can back out certain trim levels, and I deploy various methods. For example, you can look at the used market, and of course in Cybertruck the available data is quite limited because it's quite a new vehicle. But if you look at comparable vehicles and different trim levels that are in similar price points, and you look at the distribution on the used market, you have some idea of the proportionality, and you can use some other methods. I'm not going to spill all of my secret sauce, but there are ways how you can back this stuff out, and I deployed the various methods, and then I apply obviously judgment, and this is basically the results in what you see in front of you in these numbers.
All right, we only have a few more minutes, and people are probably going to wonder why I'm not asking about ZEV credits. But I think the ZEV credits is something that has been dealt with quite extensively. The last one on my list that I'm always curious about how you or other analysts are doing it is the how you're taking into consideration the sequestered amounts on the FSD, the FSD monies. So in other words, yeah, go ahead.
Yeah, very good question. For that, we have to jump to the last slide of the presentation. There is some interesting disclosure which you can use. There's obviously on the balance sheet the disclosed amount of deferred revenue, which gives you some indication, which is roughly 3.5 billion from memory. But then there is some other very interesting disclosure Tesla provides. I just try to find it amongst all these slides. It's quite far in the back of this document. And I'm sorry, it might not even be in this document.
Okay,
there is believe it or not, there's even more extensive version of this analysis. and so basically, so I tried to explain it to you in words, which in the interest of time is better anyway. So Tesla, what Tesla does, in every quarterly report, there is a note in the report that says of the deferred revenue, which is most related to unsatisfied performance obligation in relation to the FSD, we expect to recognize of the current balance X million. And so what you can do, you can go back to these old predictions, the predictions from each quarter in 2023, and then you can actually look at what amount was actually later released. And what you will find is that for a number of quarters, Tesla always underperformed. Tesla never actually realized as much as they told us in the SEC filing. And this also coincides with the periods where FSD didn't make huge progress. I mean, it always improved a bit, but it simply didn't improve as quickly as
Ah,
anybody, as basically Elon expected, etc. But and unfortunately, I don't have the slide here right now. It probably takes me too long to find. So, but what you see is that in the last 2 quarters, from memory, Tesla started outperforming that guidance,
hmm,
and so something happened, and either there's growing confidence because there's some management discretion in releasing these revenues. The
sure.
CFO, it talks basically the way this works in companies. There's the auditor, the company shows the auditor what they um, what they release, and there's some bullet points why they think this is justified, blah blah blah. But long story short, the auditor, if he or she is happy with that explanation, they sign off on it, and it basically becomes part of the reporting. And something must have happened because Tesla basically had to tell the auditor, look, we estimated last year we would disclose this much, but certain these things have now changed, and now we think it's justified that we recognize more. But this is kind of the story around this. So something happened that was not expected 4 quarters ago, and which allowed Tesla to actually take more money out of that, let's call it reserve, and
Right,
put it through into to the P&L.
right.
And this I often call it the honeypot. The honeypot
Yeah, yeah.
Tesla is very large, and once autonomy is solved, and Tesla has what they call satisfied the performance obligation in accounting theory, they should be able to release that honeypot. And it will not be completely released because there are some elements that are tied to long-term promises Tesla made in other respects that are also shown in that honeypot, but a significant portion of that could in theory be released. And because that honeypot is so large relative to Tesla's earnings, uh, once that quarter hits, when Tesla decides, okay, now it's time to reduce that honeypot, this would make a significant this would make for a significant earnings surprise. But this is something I'm not modeling in. I'm basically just looking at the outperformance, look at the guidance, and apply an adjustment to Tesla's FSD, deferred revenue release guidance. This is what I do.
Okay, so this could be a surprise. All right, AJ, I want to be fair with you with regard to your desire to be able to jump off when the market opens. We're recording this at 6:30 California time right now, and 6:30 a.m. And so, thank you so much. I think everybody can see that watch the show here why they should be subscribing to you on X. I think there's nobody that gets into the detail, and I appreciate. What I really appreciate is that you were able to really prove to me that these categories, these areas where I was curious about, you're masterfully taking care of those and looking at them in a very wise, analytical way. So appreciate the work that you do.
Thank you very much, Randy. Very kind of you.
All right, we'll let you go. And for all of you out there, as always, it has been great talking to you.
Okay, Randy.
Yes, I can't figure out how to close my.
Yeah, I just stand
Oh,
still, so
if
I
would
don't
you
want to
would
screw
you
up.
would you stop your screen share?
Okay, yeah.
I think that might be my problem is that the screen share
Yeah.
is.
You see, stop share.
There we go. Now I should be able to find my pause stop. Here we go. Stop recording.